I'm Janet Forrest, and this is the Nantucket Atheneum podcast. What happens when historical accuracy doesn't live up to our expectations? Who gets to decide what is historical and what is too modern or not historical enough? What blind spots prevent us from seeing history as it is instead of how we expect it to be? These are all questions I'll be wrestling with, along with Reference Library Associate Jim Borzilleri, in this season of the podcast. Step into the Tiffany Paradox. Jim, before we introduce our first example of the Tiffany Paradox in Nantucket history, what is the Tiffany Paradox?
Well, about 10 years ago, a discussion arose among writers of historical fiction where they began to realize that there were certain aspects of past life that if they actually put it in the story would pull people out of the story. So there was a limit to how accurate they could be. And one of the examples was that in the Middle Ages in England and other parts of Europe, Tiffany was a perfectly valid name for a young woman. But if you're writing historical fiction and suddenly your king is introducing his young daughter and say, here's my daughter, Princess Tiffany, people today hear that and they go, no, that can't be right. That's a name from the 1980s. That's a jewelry store. And it brings them out of the story. So what the writers had to do was to be more realistic. They had to be less authentic and less accurate. So it would be similar to writing a story about life in 21st century America and having no one named Bob or Janet or Jim or Fred, all perfectly valid names, but they might have a different context at some future point. So that's why you can't include them. So to be more authentic, you have to be less accurate. And this is what's called the Tiffany Paradox.
So now that we have a working definition, what is the first example from Nantucket history that you want to talk about?
Well, I overheard a conversation the other day that captures it nicely. So let's roll the tape.
Captain Bildad, my forecasts were correct. Spot price in London is down. New York and New Bedford is stable.
That may be true for this cycle, Captain Pillig, but word from our ships is they have missed the number and have found few whales.
Yeah, and with no liquidity events on the horizon.
Our fund life cycle may have been too short, and I fear for a successful exit.
Yeah, agreed. We've got to grow our supply chain. The Sea of Japan might give resilience. I hear they are teeming with whales.
That sounded like a Quaker whaler from the mid-19th century chatting with a modern tech founder from Silicon Valley. Kind of speaking the same language?
Yeah, that's right. And despite living centuries apart, these two industries have a lot in common. And that's because both a whaling voyage and a tech startup face the same challenge. Most will lose money or barely break even. And as a result, traditional lenders like banks stay away from giving any money into those industries. But in both of those industries, a tiny, tiny percentage, less than 5%, are wildly successful, which in theory could offset the losses from the other trips. So you've got a lot of people who want to invest, but which whaling voyages are going to be profitable? Unless you really know the industry, you're taking a huge chance. So what evolved in the whaling communities many, many years ago were three techniques and a financial structure to solve these problems. First, they learned to spread their investments across multiple voyages, which increased the odds that one would be in what they called the long tail, which is this tiny little percentage that was profitable. And this was called fractional ownership because they did it not in decimals, but in fractions. So it was 1/4, 1/8, 1/16. Number two, they made their investments through someone who really had a deep expertise in the industry. And this is what was called a whaling agent. And they would gather up the investors' money, and then they would use their expertise to secure and outfit the best ships, recruit the best captains, and the best crew. Now, this agent was frequently a part owner of the ship, but they would take a fee up front for their services, and then they would take a commission on the proceeds out back. Third, the crew, rather than receiving a straight salary, were paid a percentage of the voyage's profits. If the trip was a good one, this could be several times their probable wages. But to collect, they had to stay with the ship, sometimes for several years on these voyages. And this arrangement was called the lay system because it gave the crew a very, very strong incentive not to desert and also to work together. Interestingly enough, in Silicon Valley, they had the same issue. Most of the startup ventures are going to lose money, but a tiny, tiny percentage are going to be the big winners. And this is where the Googles and the Microsofts live. So everybody wants to invest in the winners, but they're terrified that they're going to lose their money. And so what you have is what are called venture capital firms, which act the same way that the whaling agents had acted in the 19th century. They act as the go-between the people who want to invest, and they're the ones who recruit the best talent, the people they think that have the best ideas and the best ability to bring their particular startup to financial success. Similar to the lay system, the people that are in these startups receive a percentage of the company's shares. So they are now share owners, so they also have a very, very powerful incentive to stay, at least until the entity is finally brought public. And finally, there is a sense in Silicon Valley of a mission and a purpose that exists sometimes in harmony with the United States government and sometimes not. So in that sense, they're reflecting back to Nantucket. And this was not just a coincidence. When the high-tech startups began to emerge after World War II, the financial people looked back to the whaling system and said, here's the model we can emulate. But there was a fourth ingredient for the success, and we've seen this in Nantucket. We speak of its sense of community and purpose, apart sometimes from the national interests of the American government. And this is something that pervaded not just Nantucket, but also 21st century Silicon Valley, where we start to see the same sort of sense of apartness and culture.
To discuss this more in detail, let's bring in another voice who's uniquely qualified to talk about this. Fernando Young is based in San Francisco and the founder of Beluga Labs. It's a startup that offers tax solutions for the self-employed. He also happens to be a graduate of Nantucket High School. Here is our conversation.
So I think what we want to do is start talking about some of the similarities, and then we can start talking about some of the differences. Even though we sort of think about Nantucket as being kind of insular, it was at the time globally focused. They were selling to an international market. They were concerned about what was going on politically. They were certainly concerned about what was going on militarily. They had to be very, very sensitive to any sort of change in those environments and be fast on their feet. And I think that's definitely something that's common between the two.
Yeah, no, absolutely. I think most of the startups here in the Bay Area obviously all start here, but the main focus is always on the greater market, especially just US. And then there's a lot of success actually with companies in developing markets that are, more in Asia and Africa as well. So there's a lot of focus on the international and more particularly what you were saying around law changes. I know even for our own startup, that's a tax-based startup, we're always looking at global events or, even societal changes as a way to accelerate or where you can actually fill in a nice gap.
And I think the other thing, there are some other similar things. And I think the other one is what we sometimes call entrepreneurial values. Certainly when people think of Silicon Valley or SV, that's definitely one of the things that kind of comes up. But I think even if you look at Nantucket, you seem, I came up with four kind of similarities and, feel free to correct me or add them out. One is obviously a very strong sense of competition. And, even with whale ships, they were kind of frenemies. They might be sailing together when they went out on the voyages, but they were all going after the same product. And at some point that would, they were competing both with other ships from Nantucket as well as other ships from around the globe. The other one is proclaimed reverence for a kind of meritocracy. That no matter where you came from, once you're on that whale ship, everybody was equalized. And we know, for example, even among Nantucket whale ships, you could be the son of one of the owners, but if you couldn't cut it, that would be your last trip.
I had a question about competitiveness that made me think when we think of the whale ships, you needed a lot of bodies because it was very high risk. And so even though there was a lot of competition, in some ways your competition was training your future seamen. And I'm wondering if there's any similarities to that in Silicon Valley with the competition also potentially serving future startups.
Yeah. I think it's interesting. I think it depends on what stage you're at. So I think a lot of the early stage startups and companies that are starting today, for example, there's this attractiveness of being a lean startup. I think there's a lot of literature around it. And there's a lot of ideas where if you're able to, limit some of these early hires, the founders are able to retain more equity, right? So you're able to, if you hit that home run, come out with a lot more. I think some of those later stage startups, it is a race for talent, right? We're seeing like Meta spending millions of dollars on hiring packages just to bring someone in who may be an expert on one specific part of their code as they're building some of these AI developments. So I think it depends on the stage of the startup and really like what they're trying to do. But I think on the early, I think that's a little bit different, right? And I was thinking more around like why a whaling ship would take money versus like why a startup would take money. And I think sometimes the incentives are a little different, right? So for a whaling ship, it's like a big hardware upfront capital investment. Like even if had all the skill in the world, if I don't have a whaling ship, I don't have a whaling voyage, I can't go out there. That's changed a little bit with Silicon Valley, right? The saying is, if you have a MacBook Pro, you could build $1 million startup, right? That's all you need. So for VCs, really where you become attractive is it allows you to accelerate a lot more quickly rather than start or not start. So there's this idea of bootstrap, which I think is something that you wouldn't be able to do during the whaling era, where some people say, I don't want to give away any equity. I'm just going to sit here and maybe my growth will take 5 years to get to the point, where I'm a good point where if you have VC money, it could take 6 months. For a whaling ship, it was, a binary. It was like you were either going to be able to do it or not. With startups, you do have some more paths to get to that success level. Certainly, changes the acceleration for sure.
The next sort of thing, and again, this gets a little tricky, but at least it's been argued that both Silicon Valley and, let's say, Nantucket were essentially trust-based. In other words, your reputation is what made you, or was what makes you or breaks you, where you are in the startups. To go back to the 19th century, is what they called honor, which simply meant, did you keep your word? Could your word be trusted? As opposed to, okay, I'm insulated with legal documents, and if something goes wrong, I can just sue you, and that'll be that. I mean, instead, it's who you're going to be much more attractive if you're someone who is viewed as being, again, who has a good reputation for being in startups and being a good worker.
So the similarity that I see right away in that is repeat founders have this aura around them where they're able to raise VC money incredibly quickly, even if they didn't, previously have a ton of success. There's that joke that it's really like you landed on your third startup, where the previous two obviously failed if you're continuously trying to do it. But it's this idea of the learnings that you brought there. That's the trust system and the idea that you're investing in someone who knows what they're doing and has a higher likelihood of actually converting. I think where the difference is a little bit is, obviously, if you're raising money for a whaling ship, that the idea is you're going to go on a whaling voyage. With startups, pivots are incredibly common, and a lot of times you'll raise money for a shoe brand, right? Like, I'm going to come up with a new type of sneaker for basketball players. And then all of a sudden, next week, I'm actually a lawn mowing company, and now I'm making hardware for lawnmowers. And some of those investors who approach the table for a sneaker company are now invested in a lawnmower company all of a sudden. And I think that is kind of twofold. One, it shows that you have to have great trust in those founders, because at the end of the day, that's who you're investing in is the human being, rather than like that end product where, of course, the return is the hope, but the vehicle to get there can look totally different from day to day, month to month. But the trust factors, maybe arguably are even greater, because you do have to then, really you don't really expect that there's going to be this whaling voyage, and you got to predict what the future months are going to look like, or predict, hey, I may have my return in 2 years when the whaling voyage comes back. But it could be decades. Look at Airbnb, for example. Some of those early investors didn't get a return till 12 to 15 years after they launched. That's a long portfolio. There's other companies who are making a return in 8 months. It's a lot less predictable than I imagine it could have been during the whaling era.
Yeah, and hold that thought, because we will be talking about some of the other differences in a second. I definitely want to tease that out, but I just want to put the last thing sort of out here. And this is a little tricky as well, but that's just that I think both shared a kind of sense of mission that transcended, let's say, national or regional interests. And with Nantucket, we have to sort of go back and remember that partially because they were pacifists, partially because they were so business oriented, those in combinations kind of justified Nantucket's actually negotiating independent peace treaties with England, both during the American Revolution and during the 1812 War. And if you go back even farther, during the so-called what we used to call French and Indian Wars of the 1750s, there was a quota imposed on the colonies for how many people they should, how many troops they should be able to provide. And Nantucket got an out by saying, A, we're pacifists, so we wouldn't be soldiers anyway. And B, we're too busy at sea, so you should give us an out. And in all three cases, needless to say, this kind of put them at odds with their neighbors who were not exactly happy to see this place turning around and saying, okay, we have these national interests, but we're going to kind of go our own way here because our needs are more global. And I know, at least stereotypically, what we think of as Silicon Valley was until very recently considered apolitical, but I get the feeling that's kind of changed a little bit. But there's always this sense of we are promoting the technology that will change the world. Therefore, we can't let short-term national or local interests get in our way, or at least we have to balance them off a little bit.
Certainly in my experience and my direct industry, I think to your point, that's, I don't want to call it like optimism, but there's a certain sense of like a utopia future, and that's what we're striving for. And it's like this idea of like you aim high, you miss high, right? Where it's like when you're talking to even VCs, right? It's just a whaling captains predicting, hey, I'm going to come back with the biggest whale that's ever been caught in the world, and that's like the promise. Not I'm going to come back with a full ship. So it's a little bit of a different communication. That's the same thing with startups. It means that because of that, some of those, smaller things like geopolitical issues and things like that have to be overlooked, because in this utopia world, that doesn't exist, right? It's just like you being the largest organization possible. Where some of those issues change as well is companies that do more of a consumer play. I've seen be more interested in that, and almost in the inverse, where instead of them not focusing on it, they actually attach themselves onto cultural things. So they'll look for these cultural shifts, and that'll be like the problem that they're solving. So they're actually incredibly interested in some of the things that are happening around the area as a means to be the company that exists because of this. Whereas a year ago we wouldn't have existed. 5 years from now we may not exist, but right now this is why there's a need, and that's why we can grow so quickly. So it really depends on like what the company thesis is, but you either have this greater utopia vision or this immediate, it's this cultural thing that needs to happen today because it won't exist tomorrow.
And this is a perfect segue to what I want to sort of get to next, which is the differences. I think there are two major differences. The big one, and let's get that out of the way, is that obviously whales can kill you. And I think, there are, for all the risks in Silicon Valley, which are very real, you're not risking your life the way you were going on a whale ship. But that said, and that out of the way, I think you have absolutely hit on what I think is the other major difference. And I think this kind of goes to the core of where the similarities kind of come to an end. And that is, if I had to put it another way, I would say it's like there's an almost antithetical tolerance for failure. Because as you noted, it's built into the VC model. The assumption is, yes, a certain number of failures are going to happen, and it could well fall on your shoulders 1, 2, 3 times before you actually have the major success. Whereas when you go back and look at whaling, a captain of an unsuccessful trip had real difficulty securing a future whaling voyage. I mean, you were almost tainted from the beginning. And I think that led to the other major difference, which is whale ship captains were given orders to go to a certain place, even if it was on the other side of the globe. But there was kind of a herd mentality, because if they get there and all the other captains are saying, yeah, there's no whales here, let's go there, they'll follow them because it's safer that way. If they become the one captain that hangs around and everybody comes back with a full ship except them, that's it, their career's over. Whereas if everybody comes back with a full ship, well, it was a tremendous risk, and maybe you succeeded, maybe you didn't, but the risk of failure was so great that you see them all kind of moving around in a group. And I think that is, whereas, as you said, in Silicon Valley, it's actually built into the formula.
Yeah. Yeah. I mean, I think it's twofold. I think, we see these bubbles that have been happening. The internet, obviously, in the early 2000s, and now AI today. And I think it's like in two directions. One, I think there's just a lot more startup founders who are thinking and ideating around AI. And then I think there's a lot more VCs that their investment thesis is only AI. If you're a company and and it's almost changed to, contradictory to what I was saying earlier, but even if you have a good reputation, maybe you're a repeat founder, but if you are trying to make this sneaker company and then you have another founder who's 17 years old, no experience, but they have this AI company, they may actually have an easier time getting that funding because they're following this big bubble. And there's this idea of, well, if it's going to work out, just think about the returns. We're going to be able to replace, it's 10x the industry, it's 10x the returns. That's the whole idea. Mind you, it's a little bit scary because with similar to a whaling voyage, perhaps that whole part of the ocean has no whales. Similar with AI, if the bubble bursts, none of these people are going to have returns. It doesn't matter if you were, in the infrastructure part of the AI or, the customer facing end. It doesn't matter. It's all based around the same technology. So I think that's where it's a little bit different. But I do think that contradictory to the whaling era, we do see a lot of founders who go, where nowhere else is going. And there's this idea of, all the great startups sounded like crazy things in the very beginning. Me shipping DVDs across the country sounded like a crazy idea in the early 2000s, and now Netflix is a giant company, right? Even Chewy, right? Like, I'm going to ship you dog food across the country, but now it's something that's totally normal. So some of these ideas that sound crazy and no one else believes in turned out to be the ones that really worked, whereas a lot of the followers, don't really have those returns. And I think that is something that's a little bit different, where the market share during the whaling era could be greater, right? At that point in time, there were whales that it was possible everyone on the voyage came home with a full load. In the startup world, that's not possible. The market realistically is not large enough where everyone can have an equal part. It will be that some will have a much greater segment of it. And you may be able to survive. You may return, on the voyage home, as you were saying, right? You're not going to die, but you're not going to have nearly as great returns, and your investors are not going to have those returns at the end of the day, just because not everyone's going to come out with the equal share. So I think that's the danger of fishing in the same area or building in the AI world, is that it's naive to think you're all going to have equal returns and you're all going to live in this utopia. It's only going to be one or two companies that will live in the utopia, and everyone else will be back at zero.
Yeah, and just thinking about some of the other differences, I just want to run a couple of things past you, and you can say, yeah, that's true, or maybe it's not. And I think, obviously, to your point, they're going out hunting down a possibly, because they didn't know any differently at the time, unlimited resource. And it was certainly, in theory, there were more whales out there than they could at the time, using 19th century technology, actually harvest. They made, horrific inroads in terms of destroying them, but it really wasn't until the technology of the 20th century that we came very, very close to driving the whales to extinction. So to your point, everybody could come back, in theory, a winner. Whereas, as you noted, if you've got 20 companies all going for a 10% market share, there's going to be a shakeout. And I think that's the difference. The other one is obviously that, Silicon Valley, once they do have a product out there, they will protect it via patents and licenses and, legal copyright, so they can sort of maintain it. Whereas with whaling, it's just they're going out and they're harvesting a natural resource that they didn't own in the first place. And you either once you came back and you sold it, that was it. You're done. There was nothing that, the profit stream ended right then and there. There was nothing to license or to sell out. Once that oil was sold, it was sold, and that was it. So it's kind of each one was a very, very discrete kind of, each voyage itself was kind of discrete, which kind of gets to the other sort of difference. And I don't know how big a difference this would make in terms of the economic structure, but something that Silicon Valley has that whalers definitely lacked was direct and indirect government support. This could be, certainly in the past, the government funding for, certainly from the military or for private uses. Also, obviously, the patents and trade agreements, which we talked about. But I think also there was, the historically tight integration between the government and academia and business as incubators. That you mentioned the 17-year-olds who are starting up in high school. Well, that high school is probably, in a very wealthy district that is funded by the people who have made their profits in the past in Silicon Valley, or they're attending one of the public universities or one of the endowed, like Stanford universities. So, I think there's more of an interlock there. But I think the one I sort of want to really sort of focus on for a second is, what whale ships lacked was the ability to cash out prior to the end of a voyage. And I think that is also one of the differences. Obviously, if you're in the company and you're a founder, you want to, you're hoping for the big payout. But if you're in a Silicon Valley investor, there are moments where, a company can go public, but it's still losing money. And there've been, so if you're an investor, you can get your money, get out with a sale after an IPO or even before then. Whereas with whaling, that really wasn't possible.
Yeah, I think there's this interesting thing that happens there you're talking about, where it's this like pre and post IPO company. So at pre IPO, the investor can't check out at any moment. Even if they own 40% of the company, the way that we do things under a safe is what it's called, but it basically gives founders the full ability to make controls of the sales or the future raising rounds, not the investors. Once it gets to some of those later stages, certainly post IPO, then you have a board of directors, and anyone who's invested in it can then withdraw. I think the interesting thing is really the operators, right? They're the ones who have the opportunity to cash out at any moment. It's similar to if you're on a whaling voyage and you're halfway, to your landing site, and you're like, actually, I want to get off this ship. Someone else can jump in this, and I'll just take 1/8 of what I was going to earn, but I at least get to walk away with something, without having to have gone through with full execution. That's a similar thing with startups, right? We have this idea of acquisition, and a lot of startups get built with the idea that I'm actually never going to reach this utopia, but somewhere along the way, I'm going to sell to someone else who can reach this utopia. And then me, myself, individually, I can walk out around with cash. And there's that disconnect with the investors. The investors don't see that return right away. The founders get to see that return. And now with post IPO, that's certainly then when the investors are able to check out at any moment. But I think, if you just look at startups, there is this big trend where a lot more are preferring to stay private for a couple of reasons. But the investment thesis has really changed to become even longer tail because of this, where, even Y Combinator, a company that invests, I think they do like 100 companies every 4 months, right? So just like think about the amount of investments, $500,000 into 100 companies every 4 months, a significant amount of money that's going on in investments. They've really only made their return with like 3 companies in their entire existence. And it's not because all these other companies are dying, but it's just they're not yielding the amount of returns needed for the amount of time that they're holding these investments for. They don't get that quick hit where the whaling ship comes back and they get to sell their stocks. Again, we go back to the Airbnb example. Sometimes they have to hold on for 15 years without seeing 1 penny of investment, no dividend returns, nothing. And then they get that big payout and they're able to enjoy that. But at any point during that 15 year journey, the founders could have acquired or sold out, and they had the benefits, reap the benefits. So I think it's changed where this model's almost been more complementary towards founders, and I think that's why you're seeing a lot more people founding companies, because your risk is super mitigated when you have that VC money, and you always have multiple exit doors at any point in your journey. Certainly IPO is the ultimate utopia, but at any point before that, you have the opportunity to come out with cash, come out positive from that experience.
Yeah. Whereas if you're a whaling captain, you don't get to cash out in the middle of the Pacific and go, that's it, I'm done, I'm going home.
You can't bail ship and be rewarded for it. Exactly.
So I think the only other thing I wanted to sort of bring up, and again, it kind of goes without saying, but I'm just going to say it, but in terms of similarities, I think when people point to Nantucket or they point to why VC, the VC culture is so successful, they'll always say there's a shared culture, there's a shared sense of community. And I know he's kind of touched on that, but I think, again, you can't think of physically 2 more different industries, but I think they both Nantucket and what I've seen of, the VC culture, what I've seen of Silicon Valley, it seems to be the same sort of thing. You've got this sense of self-identity, this sense of here we are, we're doing this, we're changing the world. We are to some extent exceptional, in the sense of we are somewhat different from the rest of the world.
Yeah, no, absolutely. And I think that, especially having been here in San Francisco, having moved from Nantucket, it's crazy to see people, with a one-way ticket. The idea is that, it's almost like the gold rush. If they make it here, they'll figure out a way to keep making it here. And you see these people land jobs and land fundraising. It's this idea that you're following this like ruthless American dream or pursuit of that, utopia. I think the other thing that's interesting about it too is that there's almost a superiority complex that comes with it. I'm sure Nantucket had a similar thing with the other whaling towns where, it's naive for me to be San Francisco is the only VC funding place in the world. That's not true. New York, Austin, and certainly international markets. But there's almost this, idea where the money in SF is better. It's somehow more green than the money in New York. And people talk about it where the worst mistake in the world you could do is move your startup from San Francisco to New York City. Just because there's this congregation of talent around San Francisco. If I need the best engineer, 10 out of 10 times, they're going to be right here in San Francisco already. And that's because the companies are already here, right? We have the education system here. We have fantastic schools in the area, but we have companies like Google, Amazon, Tesla, Apple, all right here within the Bay Area that engineers who, have this experience are able to be positioned really uniquely to go into those startups. Outside of that, all those VCs tend to talk to each other, right? There's this idea of like pursuing what's hot right now in the market. And I think interestingly, what you were saying about earlier is, I think it's almost like the power dynamics change sometimes with the fundraising conversations where VCs are actually the ones who are able to be choosing who they want to be invested in their company rather than seeking investment out, especially if you're considered a hot startup. If that's the idea, there's this idea of, my round's overcommitted already. I've already priced my round and I have more interest than I have shares to go out. And because of that, VCs have to figure out ways to become even more attractive to startups. And they'll say, well, I can introduce you to NBA players, or I can give you tickets on my jet whenever you want. Right. So there's these perks that are now coming with fundraising that probably weren't around for whaling captains. It wasn't like you were going to get, necessarily a better seat, depending on what VC you worked with or which investment vehicle. But certainly it is true now with the startup world. And again, that wouldn't happen if you weren't in San Francisco, if you weren't able to have that word of mouth connection and be at those events. It certainly makes it a lot harder. Just look at the Fortune 500 companies, a lot of them did start out here in the West Coast, and that's not an accident. That's purposeful choosing of where to have your headquarters, of where to start your company and where to hire all that talent from.
Yeah. Well, I think there's somewhat of a similarity because if you were a captain and you came back from a winning voyage, full ship, maybe it was so successful that you actually had to pull into port somewhere and offload all your cargo and then go out again. So you doubled your investment. If you came back with that kind of record, you could write your own ticket. Even though for all the differences, I think there is a similar mindset because even though they were considered Quakers and very sort of, docile people when they were on the mainland, one characteristics of Nantucket whale ships is that once they saw a whale, nothing got in their way. They would go out and just take incredibly dangerous risks. And it wasn't just the captain sitting on the ship. No, he's out in one of the boats. The mates are out in the boats. If they're not the harpooner, they're going to be the boat steerer. They're right there taking that chance. And I think it was that sort of incredibly aggressive, we can do this mindset that I think there is, at least in terms of personalities, I think both, if you look for the descendants of the whalers, I think you will find them to some extent in places like, like Silicon Valley, like San Francisco.
I agree. Yeah. I mean, it's certainly, I think even if the companies are very different in their industry, there is this race to who's the first one to get 100 million ARR, right? Like in your batch, even like there is this race on numbers, even if the playing field is totally different, the sports are totally different. But the idea is that, the industry is the same, the investment vehicle is the same, and it makes you more of an attractive founder, what you were saying with Lapel. And, I think going back to some of those experienced founders, there's a lot of people who raise money pre-idea. They literally don't know what they want to build, but it's because I have either, a technical experience or because I have a distribution channel. I'm able to then get that funding and, the VCs know that I'll be able to make it some way. But yeah, it's incredibly ambitious here. And I think you see a lot of founders, there's this big shift for people who, work like, it's called like a 996, but it's crazy hours over the week. No family, putting everything on hold just to be able to build this startup. And I know a lot of people in my batch even like were mentioning that they don't even have a mattress yet. And they were able to earn a mattress when they raised their seed round. And then when they raise their A round, perhaps they can get a bed frame. It's this idea that I'm putting it all on the line. I'm going to be incredibly uncomfortable for the next 5 to 10 years in order to get this utopian future, this great returns for both my investors and myself.
anyone who's read anything about whaling knows that once they catch a whale, that's it. You don't sleep for the next 48 hours. Although I do think, one of the differences we have to acknowledge is on a whale ship, there's a lot of downtime. I mean, you're on a sailing ship, and it's going to take a while to get to the other part of the world.
Something I was thinking about as we compared the risk, when you look at that chart that Jim will put in the show notes, it's almost identical, even though, it's hundreds of years between these industries. And during whaling, it was considered luck. There was a lucky captain, a lucky ship, and they didn't obviously have the data and the metrics to measure things and forecast. How does it compare? Is a lot of it still luck?
I don't know. I think it really that depends on who you ask. I think there is a good way that I got startups described to me, or really like pursuing this idea, is there's this thing in the startup world called product market fit. And that's when you have the perfect product that the market has this big need for. And when you have that, it's almost like the startup starts steering itself, right? I imagine it's similar to in the whaling, if you have this whaling breeding ground and all of a sudden there's all these whales all around you. And it's, again, it's more than you can even carry. A similar idea with a startup. And a lot of the times it's hard to actually know where that product market fit is. You can have an idea of it, but the analogy or the metaphor that was described to me was you're a rowboat out in the middle of the ocean. Your job is just to put up a sail and see which way the wind catches your sail. You can try to point it in certain directions, but the best thing to do is actually lay off all the sails and just let it be pulled, and have the idea pulled out of you. So I think to that extent, it's certainly luck. But I think for a lot of the startups, it's almost an execution of a founder. And I think this is true of whaling captains, where it's if it didn't work that first time, it's staying out there until it does work, right? So not coming home with an empty whaling ship. And for founders, it's much easier for me to say this is too hard than when you go work at Google and that's it. But the more satisfying thing is, today I may not have the idea. It may not be next month. It may not be next year. It could be 3 years from now by the point I'm really having success. But when I do, it's going to make all that pain worth it, right? And that removes a little bit of that luck because I'm staying there. So I'm increasing the chances that I can have that opportunity delivered back to me.
The other thing I was thinking about is the lay system and how there's people at the top of the hierarchy who invest and have the power. And then depending where you are in the hierarchy, that's how much return on investment you get. And for some of those sailors, it was nothing and probably cost them their life. And I was wondering, we talked a little bit about this, but could you talk about that comparison, the lay system compared to how it is in Silicon Valley now?
Yeah, for sure. No, I mean, I think there is equity is one of the greatest things you can do to attract early hire. I was thinking around that too. And Jim, your comparison around people who were harpooners and mates, and you really needed these very technical people who, the skills developed over time and over practice and through education. Same with Silicon Valley right now. Founding engineers, founding designers, your lead of product, your lead of marketing. It's all super important. And there is a race. There's only a finite amount of these people. So for them, one of the biggest vehicles that you can use to actually attract them is giving them equity awards. And for startups, honestly, most founding engineers will get like 4 to 6% of the company. So it's a pretty large return. And, it can seem small in the beginning, but when some of these companies IPO, obviously the founders have a lot, but some of these lead engineers, that's enough for them to also be retired for the rest of their life. And that's what attracts a lot of these top talent that could be making, $600,000, $700,000 at Google, but they'd rather go be working for a startup making $70,000 at the prospect of, hey, I can cash out with $50 million in 5 years or in 10 years. So absolutely, that's definitely an incentive. And I think interestingly enough, how you keep that incentive throughout the years is through the different rounds that startups will go through. So instead of a whaling ship where I need to get money for each voyage, a startup, well, I guess similarly has these rounds where you'll go through pre-seed, seed, A, B. And as you do that, the amount that your startup is worth increases. So if you own 5%, you could do the math on, okay, my $1 million just went up to $5 million. Okay, now I just went up to $50 million. So you can do the math, and that continues to excite people to stay at your company. And that's why so many companies, try to raise money pretty frequently at a greater round. And I think that's the interesting thing too. A little bit of a difference that I was seeing is that you do almost put the value behind the startup before your first voyage, right? So it's almost as if a whaling captain saying, well, Jim, I can guarantee you that I'm going to come back with $25 million. And if I take your investment, you're also believing that I'm going to come back with $25 million worth of whale. Similar with startups where, it's a two-person team in an apartment, but, we're saying that we're worth $15 million. Just the idea and the execution of the founders are a $15 million investment. And that's what drives people in. And, this is how you see some of these companies like NVIDIA raising at insane rounds that, sound astronomical because it's this utopian future. If everything works out, we will be worth $100 billion. We're going to be worth the world economy. That's definitely a little bit of a difference that I was seeing too.
We talked about bubbles. There's the .com bubble, and the whaling essentially was a bubble. We ran out of whales. And the technology changed. We were able to drill for oil and that changed. So it all kind of happened at the same time. And there is talk, is there an AI bubble? Probably in some sort. What will be the consequences? Who knows? So I was wondering what you see as some of the differences between the bubbles in Silicon Valley and in the whaling era.
I think if we think about like whaling, the reason those voyages were going out was because it was a global tool or tech that was needed. All right. Everyone needed that oil to light lanterns. And it wasn't like, some people were using, no lanterns, no oil. It was like pretty universally felt problem. I think that's a little bit of a difference now with some of the bubbles now, where it's not like everyone universally is using AI. And of course, this has to be a big idea because it's simple as water. We all have to consume it. So I think there is this difference where really what we're betting on is almost like the large corporations and the really high investment vehicles using AI. And that's what's going to have a really great return. Not that everyday man is going to be using AI. And that's why it's so valuable, because we're going to have 8 billion users, but it's more because we're going to have these incredible power users or data centers, right? Or we're going to be able to accelerate 10x faster. That's that big saying in San Francisco. So I think, that's a little bit different to the bubble. I think the other thing too is that, it's almost a little bit scary with some of the bubbles that happen in the VC world, because so much of the overall global economy is invested in some of these companies who can make some of these decisions pretty much autonomously. They obviously do have shareholders and board members, but if you look at the Fortune 500, if you're just putting your diversified money, portfolio into the S&P 500, you are investing in AI. Even if you're the most anti-AI person, look who the companies that make up that, the portfolio, and look where they're investing their money. It's all in AI infrastructure, data centers, or the development of AI themselves. And I think that's where it's different than whaling, where the thesis was whaling and people knew exactly what they were investing in. They knew the end product was going to be whaling. Here, it's not that. If you're contributing at all to the stock market, you are contributing to this bubble where if it bursts, it's going to feel the effect everyone globally. It would be a major economic downturn that isn't just we didn't come home with whales, but it's all of a sudden, top companies are going under, massive layoffs across the country. Could happen. So yeah, the bubble definitely it's a lot more risky, I would say, and it's almost perpetuated on this idea of very few winners rather than a globally felt problem.
Because the theme of the series is the Tiffany Effect, we should just at least sort of touch on that a little bit. And I think where we see the Tiffany Effect here is, even though we have identified all these similarities between personality and certainly in the financial structure, if we were to do a really accurate portrait of late 18th, early 19th century in Nantucket, it would feel too modern. And I'm constantly reminded of something that I kept reading over and over and over again. And that is how obsessed Nantucketers were with news. That they would have commercial reading rooms. We certainly had the Atheneum, but they were just hanging around in the various accounting houses, just gossiping. What's the word from this place? What's the word from that place? What's the price of oil here? What's going on? Is Spain on our side or are they on their side? And it almost feels as if in many ways they were sort of, trying as best they could to achieve the same level of information consumption that's almost taken for granted today in Silicon Valley. I think that is where we start to see the Tiffany Effect.
On the next episode, we discuss the 1920s restoration of the oldest house.
The stories that they're telling about the house in the 1920s is perhaps more illustrative of what they were thinking about the house than documentation and photographs that they were taking on the job site.
This has been a production of the Nantucket Atheneum. It was hosted by me, Janet Forrest, and it was co-hosted and researched by Jim Borzilleri. Production support by Shire Video. The Nantucket Whaler was voiced by Reference Library Associate James Grieder. A special thanks to tech founder and Nantucket High School alum Fernando Young of Beluga Labs for joining us. If there's an example of the Tiffany paradox in Nantucket history that you think we should discuss on the podcast, send us an email at jforrest@nantucketatheneum.org. The Nantucket Atheneum is located at 1 India Street in Nantucket, Massachusetts. We would love for you to stop by and say hello. You can find us online at nantucketatheneum.org or search at Nantucket Atheneum on Facebook or Instagram. You can find all the previous episodes of this podcast on Apple Podcasts, Spotify, or wherever you're listening now. If you liked this episode, please share it with a friend. Thanks for listening.